Okie dokie. Now, in this episode, we're going to discuss the Gordon growth model in more detail than we talked about in the previous video. Okay, take a deep breath. I know most people do not like math. I'm not a big fan of math, but it's going to be okay. We're going to get through it together. We're going to make it happen. Okay? So as we talked about, Gordon growth model, 1960s economist Myron Gordon. Handsome fella. Look at that hair. That's nice hair. That's nice hair. Now, he created this model as a method of valuing company stock price, okay? And it's based on a theory that the stock is worth the sum of all its future dividend payments discounted back to their present value. Okay, that sounds like craziness. But basically, in other words, it's used to value stocks based on the net present value of the future dividends. This is basically the formula that will tell you a stock's intrinsic value. Okay, so what is intrinsic value? In finance, intrinsic value or fundamental value is basically the true value, the essential value of a stock or some sort of an asset, basically independent of its market price. Okie dokie, now let's look at the equation. I know. Equations in general are painful for me to look at, but they are important. They do serve a purpose, so stifle your anger long enough to just go through this with me. Basically, the formula reads like this. Intrinsic value is equal to D1 over K minus G. D1 is the expected annual dividend per share for the following year. K is the required rate of return, and G is the expected dividend growth rate. So, for example, let's say the Timbo Show is offering stock on the stock market for $37 a share. I may add, tremendous value there. Tremendous value. Anyways, let's say the company is requiring a 9% rate of return. The annual dividend is, I'm feeling generous, $2.20 per share. Investors can expect the dividend to increase by 4% annually. So the way this will look in the equation is V, which is our intrinsic value, right, is equal to 2.2 divided by 0.09 minus 0.04. Now remember, you have to do the 0.09 minus 0.04 first, since that is in parentheses, right? Which gives us the V equal to 2.2 divided by 0.05, which eventually you divide that, and we have V, the intrinsic value, is equal to $44. Hence, this stock is a good buy. Why is it a good buy? Because the stock would be considered undervalued in this case. It's currently going for $37. Intrinsic value we have found to be $44. In this case, buying Timbo Show stock would be considered a great deal since its intrinsic value is $44. However, before you go running around and doing this for every God-blessed stock that you see, and it's good practice, you should get in the habit of it, but big caveat, this is not the be-all, end-all by any stretch of the imagination. There are some assumptions made with this Gordon growth model, and you know what happens when you make assumptions. Some of the assumptions of the Gordon growth model assume a lot of the following conditions. The company's business model is stable. For example, there's no significant changes in its operation. It also assumes that the company grows at a constant and unchanging rate, which is very unlikely. Pretty much every company does not grow by a rate that doesn't ever change, nor do they always grow all the time. Sometimes they grow, then they stop growing. So again, a big assumption. It also assumes that the company has stable financial leverage, and the company's free cash flow is paid as dividends. That was a Gordon growth model. In a nutshell, not too crazy, not too bad. The math was relatively easy. It wasn't anything too crazy, was it? Again, go ahead, like this video if you liked it. thumbs down it if you freaking hated it. And if you have any questions, anything like that, drop them in the comments. You have any ideas for stuff you may want to see coming up, anything entrepreneur related, anything business related, anything market related, whatever it is, go ahead, put it down in the comments. Go ahead and subscribe if you haven't subscribed already. Hit the notification bell if you're into notification bells and all that kind of stuff. And I will see you next time.